All right, let's get right into it. If you've just moved to the United States, you're probably facing a huge financial challenge, building credit. It can feel like this black box. Totally confusing, right? But here's the thing. Understanding how it works, well, that's your key to unlocking your financial life here. So, let's crack this code together. So here's the weird paradox that trips so many people up. You could be a financial rock star back home with tons of savings, a perfect payment history, but the moment you land in the US, it's like none of that ever happened. Poof, gone. To the American credit system, you're starting from absolute zero. You're what they call credit invisible. Credit invisible? What does that even mean? Well, it's pretty literal. The big three credit bureaus, that's Experian, Equifax, and TransUnion, they have no file on you. Nothing. It's like you don't exist in their world. And that's a huge problem because without that history, how is a lender or even a landlord supposed to know if you're reliable? They can't. And that's a massive wall to hit right from the start. And this is where it gets really frustrating. I know. You're probably thinking, but wait, I have a great history from my home country. Why doesn't that count for anything? The hard truth is, the systems just don't talk to each other. The US credit world is kind of like its own little bubble. It's a closed loop. So you've got no choice but to start building your reputation from scratch right here. Okay, so here's our game plan. We're gonna look at this credit invisibility paradox, then we'll tear apart the FICO score to see how it really works. After that, we'll cover the tools, the levers you can use to build credit, and wrap it all up with a blueprint for success. All right, time to get analytical. To win this game, you have to understand the machine you're being judged by. And in the US, that machine is, for all intents and purposes, the FICO score. I mean, think about this. 90% of top lenders use this exact model to decide if you get that car loan, that credit card, that mortgage, and just as importantly, what interest rate you're gonna pay. So yeah, we need to know how it thinks. So this whole complex, mysterious FICO system, it really just comes down to 5 key things. That's it. These are the gears inside the machine. If you understand how much each one matters, you've got the roadmap. Let's start with the absolute biggest pieces of the puzzle. 35%. Just let that sink in for a second. More than a third of your entire score hinges on this one single thing. It is, by a huge margin, the most important factor. So, what is it? It's your payment history. That's the whole ballgame right there. Simply paying your bills on time, every single time, is the most powerful thing you can do. Every on-time payment is a gold star for the algorithm. Every missed payment is a massive red flag. This is the foundation. Everything else is built on top of it. Okay, so next up is the second biggest piece of the pie. And it's another heavy hitter, clocking in at 30%. This one is all about how you manage the credit you actually have access to. The official name is amounts owed, but that's kind of misleading. A much better way to think about it is credit utilization. See, it's not really about how much debt you have in total, it's about the ratio. How much of your available credit card limit are you actually using? If you're maxing out your cards, lenders see that as a sign you're in financial trouble. Here's the pro tip. Always try to keep that number below 30%. That's the magic threshold. All right, moving on. The next chunk is 15%. Now, this is a factor you can't really change overnight, but it's super important for the long game. And it's all about one thing: time. We're talking about the length of your credit history. You know, the algorithm loves a long, predictable story. A longer track record just gives lenders more evidence that you're reliable, which gives them confidence. And that's exactly why you want to start building credit as soon as you can. The second you open that first account, you've started the clock ticking on this crucial piece of the puzzle. So the last 20% is split right down the middle into 2 smaller pieces. First, you've got credit mix. That's 10%. This just shows you can juggle different kinds of credit, you know, like a credit card and maybe a small loan. Then the other 10% is new credit. Think of this one as the system's brakes. If you go out and apply for a bunch of new accounts all at once, it looks risky, and your score will likely take a temporary hit. Okay, so we've deconstructed the machine, we know how it thinks. Now let's talk about the actual tools. What are the levers you can pull to start building a great history and really boost that FICO score? The first and most common lever is the secured credit card. It's a fantastic starting point. Here's how it works. You give the bank a small cash deposit, maybe $200. That deposit then becomes your credit limit. You use the card just like any other, and here's the magic. All your on-time payments get reported to the credit bureaus. Bam! You're directly building that massive 35% payment history, and you're even getting a head start on your 10% credit mix. Lever number 2 is something called a credit builder loan. And it's pretty clever. It's almost like a savings plan in disguise. The bank puts a small loan amount aside for you in a locked account. You can't touch it. Then you make small, fixed payments every month. And of course, every single one of those payments gets reported, building up that all-important payment history. Once you've paid the whole thing off, they release the funds to you. So you've built credit and saved some money. Pretty neat, right? Now for lever number 3, and this one can be a game changer. It's becoming an authorized user on someone else's credit card. This has to be someone you trust, like a family member. Here's the deal. Their good history for that specific card can actually get copied onto your credit report. We're talking about the age of the account, the payment history, everything. It can be an amazing shortcut to beefing up that length of credit history factor we mentioned earlier. All right, so let's pull all these pieces together into a real blueprint for success. We'll look at a realistic timeline, touch on some other scoring models, and tackle that big question: what happens if you don't have a social security number? First things first, we need to set some realistic expectations. Building credit is definitely a marathon, not a sprint. You're not going to have a perfect score overnight. Generally, you can expect to get your first score after about 3 to 6 months of activity. Give it a year, maybe a year and a half of really consistent, smart use, and you'll see some serious progress. And after about 2 years, you can have a really solid credit history to stand on. Okay, here's a little insider detail that's really important to know. While pretty much all the big lenders use FICO, there's another score out there called VantageScore. Why should you care? Because for a newcomer, VantageScore can often pop up much faster, sometimes with less than 6 months of history. So if you're using a free credit app and you suddenly see a score, just know it might be your VantageScore and it might show up before your official FICO score even exists. It's a good way to track your progress early on. But what if you don't have a social security number? This is a huge question for a lot of people. And the good news is it is not a dead end, not at all. Many banks and card issuers will actually accept an ITIN, that's an individual taxpayer identification number instead. And there are even some really cool services like Nova Credit that can actually translate your credit history from back home for US lenders. That could be a way to bridge the gap right from the very beginning. So, we've walked through the whole thing, the system, the tools, the timeline. But if you're going to remember just one thing from all of this, one master key to the entire puzzle, what is it? It's this. In the American credit game, consistency is worth more than cash. Seriously. The algorithm doesn't give a hoot how much money you have in the bank. It only cares about one thing: your behavior over time. Remember that giant 35% slice of the pie? Your payment history? That's everything. In this system, reliability is the only currency that matters. And honestly, that should feel really empowering, because what it means is that anybody, I mean anybody, can win at this game. It doesn't matter how much money you start with. All it takes is deliberate, consistent action. So the question I'll leave you with is this. Now that you've seen behind the curtain and you understand how the machine works, how are you going to strategically pull these levers and start building your financial future here in the US?